Hey, thanks for tuning in. I've got a lot of interesting stuff to cover in this video, starting with I'm going to compare Fisker Automotive and ChargePoint stock. I'm going to answer which one of these two is the better stock to buy. Before I do that, I'm going to look at some industry data regarding electric vehicles, regarding charging stations. I'm going to look at recent developments at both ChargePoint and Fisker Automotive. Then I'm going to look at important financial metrics going back several years for both Fisker Automotive and ChargePoint and compare their valuation after putting together all of this research and analysis. So you're going to want to tune in to see all of this comparison, and then finally at the end I will answer which one is the better stock to buy.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So let's get right into it, starting with an industry perspective. Of course, global electric vehicle passenger vehicle growth is expected to explode over the next several years and several decades for that matter. Governments worldwide are incentivizing consumers and electric vehicle manufacturers to increase production and increase sales respectively. Right now, well, as of 2021, there were just 11 million electric vehicles on the roads in circulation, but that number is expected to grow to between 687 million and 1 billion by the year 2040. So that growth going from 11 million up to 687 million global passenger EVs. Now, between here and there, that's a lot of EV cars that need to be sold. And on top of that, that's a lot of EV charging stations we're going to need. ChargePoint going to benefit from that trend to be sure. Fisker is also in position to benefit from that growth as well. Now, if you've been following Fisker, then you're probably aware that in its most recent quarter was really the first quarter that Fisker really ramped up sales and deliveries. Up until this point, Fisker Automotive had been spending money on research and development in readying itself to really launch its brand, to launch its sales and start delivering vehicles. That started in the third quarter where it delivered 1,097 vehicles in Q3, and then it's growing from that. In November, they delivered, actually in October, they exceeded the entire third quarter figure, and November was tracking even better than October. So Fisker is exploding sales because they're just getting on their way. They had a few hiccups, but now they're exploding. Sales are growing. However, the one thing that came out of the quarter as well that investors were not too happy about was Fisker's difficulties in ramping up those deliveries. It wasn't smooth sailing. They realized they needed to hire a lot more people, to employ a lot more real estate in order to function effectively in making those deliveries. So their total number of marketing, sales, and service employees has increased by more than 4x since the end of 2022. That's a big increase. And of course, along with that increase in number of people, that's higher costs. And we're going to look at why that's not good news a little bit later in terms of rising costs. Investors were not happy about that. With ChargePoint, of course, the big news coming out of ChargePoint in its latest preliminary update and a replacement of the CEO because the board of directors was not happy with the performance of the previous CEO. New CEO coming in, hired as an interim Chief Executive Officer, Rick Wilmer. Hopefully will get things right. However, the company also announcing that the upcoming quarter is going to be a lot worse than expected. Revenue is going to come in between 108 and 113 million. That was compared to the previously expected range of 150 and 165 million. The company also taking a non-cash impairment charge of $42 million. That's the second quarter in a row the company is going to take a non-cash impairment charge. What this means is that the inventory that they have on hand, it's not going to sell for the prices that they thought it was going to sell for. Customer demand is a lot weaker than they initially thought it would be. So bad news coming out. I shouldn't say bad news, but bad news for ChargePoint. For Fisker, a little bit concerning news coming out from their latest quarters. Now let's take a look at these two longer term, and you'll notice ChargePoint's been generating revenue for a while now, and its revenue has been growing rapidly. Revenue growth again has not been a concern for ChargePoint. Revenue up to 150 million in its most recent quarter. And as I highlighted, Fisker had not been generating any revenue. This was really the first quarter where it generated any revenue, and it exploded all the way up to 71.8 million in its first quarter of making sales and deliveries. I wouldn't be surprised if in the next quarter their revenue actually goes beyond where ChargePoint is. So I wouldn't be surprised if Fisker closes and exceeds this gap in terms of revenue, closing this gap with ChargePoint. So revenue growth, not an issue for these companies. They're both going to increase revenue rapidly over the next few quarters, although actually ChargePoint might experience more difficulty with this recent transition. But one thing for sure, these companies are having difficulty with losses on the bottom line. You could see they're moving in the wrong direction. You can forgive Fisker for a little bit of this because they only recently started making deliveries, but they lost 99 million in the most recent quarter in operating income, 123 million in losses for ChargePoint. I wouldn't be surprised if these losses continue, although Fisker has better prospects of improving profitability in the near term because Fisker has chosen the outsourcing business model, and that makes it easier for the company to generate profits, but it makes it more difficult for the company to generate expanding profits because as Fisker's revenue grows, it's going to have to spend more and more and more on production. Whereas if you were to spend money to in-house, to build that production in-house, you build your facilities, you spend the money up front, and then as you generate more revenue, your costs remain flat because you already spent that money to build out your manufacturing, and your profit margins have the potential to continue expanding longer term. So it's a trade-off that Fisker has chosen, and I think it's going to pay off in profits sooner rather than later compared to other electric vehicle sellers who have chosen to also do manufacturing in-house. The next thing I wanted to compare these two on is their cash flow from operations, which is a similar story, downward trending, 86 million negative for ChargePoint, 96 million negative for Fisker. Again, for the same reasons I mentioned with operating profitability, I think Fisker has a better chance to improve cash flow from operations sooner than ChargePoint, while longer term, if ChargePoint can get things right, it has greater potential in cash flow from operations longer term. So it's a trade-off with these two companies with the potential compared to near-term profitability. I also wanted to highlight these companies' total long-term assets, and you can see Fisker Automotive has been increasing its total long-term assets all the way up to 928 million. A little bit surprising to see given that the company has chosen to outsource its manufacturing. What are these total long-term assets? A lot of this is research and development, goodwill, and those types of things. It doesn't really have those manufacturing facilities that it's invested in. ChargePoint, meanwhile, does have those facilities, and it has total long-term assets of 376 million. Again, you hear me talk about companies and assets. I prefer companies that run asset light business models. The more assets you have, the more profits you have to generate to make those assets worthwhile, right? Because you're spending all this money on the assets, and so that requires a greater profitability to generate a greater return on assets. It makes it more difficult. However, it also makes it more where you can defend your competitive advantage if you are able to achieve that. So again, it's a trade-off that companies make, whereas you go with the with the asset heavy business model or an asset light business model. Regardless, there's been studies that show companies that increase their assets year over year have a harder time generating stock price appreciation longer term. So the next thing I wanted to look at is total long-term debt, and Fisker has a greater degree of long-term debt at 1.1 billion compared to 295 million for ChargePoint. For the near term, I don't see this as an issue just yet. However, if Fisker is on a timeline now, if they're not able to get to that positive cash flow from operations quickly enough, this can result as an issue because they will have to refinance this debt at higher and higher interest rates if their business is not showing progress, right? If you're showing progress, then you can refinance at lower interest rates because you can go back to lenders and say, look, our business is in better shape, so you can finance us at lower interest rates. And the opposite is also true. If your business is not in good shape, it's going to cost you more to refinance this debt. So with all this money losing and outflows of cash, I also wanted to look at total diluted shares outstanding. And each of these two companies have been diluting shareholders, although ChargePoint has done it to a greater degree. If we go back to around January of 2021, they had about the same number of shares outstanding, and ChargePoint has diluted shareholders more than Fisker with 355 million average diluted shares outstanding. And if you remember back in the previous slide, we looked at long-term debt, and Fisker had more long-term debt. So this is a choice that these two made. Fisker chose to raise more money by borrowing, and ChargePoint chose to raise more money by issuing more shares. So just a choice that they made between how they wanted to raise money in the different climate between choosing debt and shares outstanding. If you borrow, that's a greater upside move, right? Because if your stock price increases rapidly, your debt remains the same, and so you're able to then at a future point sell shares to pay off that debt or use the cash flow to pay off that debt. Versus if you sell shares and your profitability increases, now you're splitting those profits among a greater number of shares outstanding, decreasing the earnings per share. And finally, I wanted to compare these two on valuation, and I chose to use the forward price to sales ratio because each of them are losing a lot of money on the bottom line and their negative cash flow from operations. So I chose to use the forward price to sales. And according to this metric, ChargePoint is more expensive at a forward price to sales of 1 compared to Fisker at a forward price to sales of 0.324. So given all of the things that we looked at, given the recent developments with both ChargePoint and Fisker, given their long-term debt and the growth in revenue and the cash flows from operations, if I had to pick one of these, now if you forced me to pick one of these, because on my own, I would not want to own either of these two. I would not want to buy either Fisker or ChargePoint. But if you forced me to pick one of these two, I would say Fisker is the better stock to buy. It's trading at a cheaper valuation and it's got better near-term prospects than ChargePoint, which is in some serious difficulty in the near term. So I would choose Fisker at this point if I had to pick one. But before I let you go, if you gained any value from this video, please subscribe to the channel. It really helps me make more videos just like this one. And if you're already subscribed, thank you so much. I really appreciate your viewership and your subscription. I hope I see you again soon.